Welcome to Odisal Associates Accounting and Finance Tutors. I'm going to solve the third question. And this question is on investment in associates. I'll read the question out. Question 3. John Barr's international trial balance for the period ended 31st December 2024. The trial balance is given, debit and credit as usual, and the descriptions are the account also. Revenue, credit 50 million, accumulated depreciation 4.5 million, PPE 40 million, long-term deposit 4 million, franchise 2 million, inventory 8 million, receivables 9 million, prepayment 4.5 million, cash 500,000. All debits. Credit, payables 5.5, 10% loan notes 4.5, 15% preference shares 4 million, ordinary shares 25 million, retained earnings 8 million. Purchases, this is debit again, 20 million, admin expenses 12 million, distribution expenses 7.5 million, interest income 2.5 million, accrued tax 3 million, revaluation surplus, this is credit 2 million, exchange difference, this is debit 1.5 million. Total of trial balance is 109 million. Note 1. Closing inventory 12 million. 2. Depreciation of PPE 5%. This should be added to admin expenses. 3. Tax rate is 20%. 4. On 1st of January 2024, my GF PLC acquired 20% of John Barr's International ordinary shares. I'm paying 20 million naira. The revaluation difference and exchange difference occurred during 2024. An item of PPE was revalued upward by 2 million, while another suffered impairment of. These issues in PPE were not yet recognized in the account. Required. Prepare John Barr's International Statement of Financial Position and Statement of Profit or Loss and other comprehensive income. 2. Using the equity method, calculate the value of investment in John Barr's International as at the end of 2024 by my GF PLC. 3. Journalize the transactions and show the extract of the SOPF, SOPL, and OCI in my GF financial statements. This is the question. Now, in order to solve this question, I've already written the solution, the first solution on the board. Now, we have two ways, two steps of solving the question. The first is to prepare the statement of profit or loss and other comprehensive income, which is on the board, and also to prepare the statement of financial position. After that, you will now show the value of the investment, and some of the things happened between from the time he bought it to the time the end of the period, at the reporting period. Now, the reporting period here is 31st December 2024. So it means that there are some things that happen before the end of the period. So we'll look at how to prepare this current statement of financial position before we will now value the investment of my GF in John Baz International. We are going to prepare this statement of financial position using IS 1, presentation of financial position. You can see the title, the name of the company, and the title of the statement that we are preparing. John Baz International Statement of Profit or Loss for the period ended 31st December 2024. So this is the format of IS 1. Revenue, 50 million. It is given in the question. Cost of sales, 16 million, is not given, but we have to work it out. Of course, we have opening inventory, which is 8 million, and we add purchases, 20 million. This will give us cost of goods available for sale, 28 million. We less the closing stock, 12 million, given in the question, to have cost of sales, 16 million. So it is that cost of sales that we are removing from the revenue that we made to have a gross profit of 34 million. So we remove operating expenses. There is a depreciation charge that is said we should compute and add it to the admin expenses. So we have admin expenses. As per trial balance, we have 12 million. If you look at the admin expenses in trial balance, then we will compute depreciation. They say depreciation of PPE is 5%. So look at the PPE there in the question. PPE is 40 million. If you compute 5% of it, you have 2 million. So if you add it to admin expenses, you have 14 million. That's why we brought the 14 million here. And then distribution expenses, there is no adjustment, no notes on that. So we bring it here. So if you remove it, you have operating profit. If you remove it from the gross profit, you have operating profit of 12,500,000. Then in the question there, we have interest income of 2.5 million. We bring it here, 2.5 million. And then finance costs, we need to calculate it. It said 10% loan notes. The loan note is 4.5 million. If you apply 10% of it, you have 450,000. So that is the finance cost. Then when you remove it from operating profit plus interest income minus from these two, you have 14,550,000. Then you apply the 20% tax on this to have 2,910,000, which will give you profit for the year 11,640,000. Okay, so you go to other comprehensive income, because this should be statement of profit or loss and other comprehensive income. Sorry, I did not include it. And other comprehensive income. So items that will not be reclassified to profit or loss, we have revaluation surplus, 2 million. Then items that may be reclassified to profit or loss, we have a 1.5 million. So if you see revaluation surplus, you see that it's on the credit side of the trial balance, that we read. So that means it's an addition, while the exchange difference is on the debit side. So it's a loss. So we have to remove it. Then we have a total other comprehensive income. If you sum the two, you have 500,000. Then, in order to get the total comprehensive income, you add the profit for the period plus the total other comprehensive income to get the profit, total comprehensive income for the period. Having finished the statement of profits or loss and other comprehensive income, let us look at the statement of financial position. As usual, the company and the title and the date. As you see, John Barr's International Statement of Financial Position as at the period ended 31st December 2024. So we have the assets, non-current assets. We start with PPE. So look at it. In the trial balance, we have 40 million PPE. Then there is accumulated depreciation of 4.5 million and the current depreciation of 2 million. So that's why we're having 33,500,000. So this is less depreciation. Then we have intangible assets. In the trial balance, the intangible asset here is a franchise of 2 million naira. Franchise intangible assets. And other non-current assets, as you see in the trial balance, long-term deposits of 4 million. That is what we are calling other non-current assets. Then we go to the current assets. Of course, the inventories are given 12 million, trade payables given 9 million, prepayments given 4.5 million, and then cash and cash equivalent 500,000. So this will give you a total of asset of 65.5 million. Then we go to equity and liabilities. Equity first. Share capital. The share capital, we added the ordinary share and the preference shares to make it 29 million. And then revaluation surplus of 2 million. And foreign currency translation reserves of 1.5 million, which is negative. You see that these were in other comprehensive income, and we are also bringing it here. Then we have retained earnings. It will be the 8 million that was in the trial balance, and 11,640,000 that we got for the year, which will give you 29,640,000. That's equity. Then non-current liabilities. We have the long-term borrowings. The long-term borrowing is the 10% loan notes of 4.5 million. And then the deferred tax is the tax that is in the tax that is there, 3 million. Then we have current liabilities, trade and other payables, which is 5.5 million. Short-term borrowings. We are looking at the unpaid finance cost since we have not paid it. So that's the one we brought here. And then current tax liabilities, 2.910 million. Total equities and liabilities, 65,500,000, as we got before. So this is the statement of financial position. Okay, having solved number one of the requirements of the question to prepare statement of profit or loss and other comprehensive income and statement of financial position, we are going to go into the question 2 or requirement 2 of the question, which states that we should use the equity method to calculate the value of investment in John Bars as at the end of 2024 by my GF PLC. So that's what we want to do. It's already on the board. They said we should use the equity method. The equity method recognizes investment at cost initially, and then if there is any distribution made after the investment, it will reduce the investment by it. If there is any gain or profit made, it will add it to the investment. So we have this on the board. Cost of investment. Investment at cost is 20 million naira. And then from this was as at 1st January 2024. Now we are now looking at 31st December 2024. First and foremost, we'll look at the exchange difference and the revaluation surplus that were in the trial balance. The exchange difference was 1.5 million, and I explained why it was a loss when I was doing the statement of profit or loss. So it's a loss. We take the 20% of it. 20% of 1.5 million is 300,000. Then the revaluation surplus is a gain. We take the 20% of it. Revaluation surplus is 2 million. 20% of it is 400,000. Okay, there is another additional revaluation surplus. Sorry, I didn't add it. That one is also 2 million, and it will be 400,000. And then they said the PPE suffered impairment loss, and you calculate the impairment loss. Okay, the impairment loss has been given 5 million. You take the 20% of it, which is 1 million. And then the profit that was made was 11,640,000. You take 20% of it, you add here, and then the share of tax. Tax paid is also 20%, so you remove it. When you add it up, you have total value of investment. So this investment has been revalued, and we have 21,828,000, which means we have made additional 1,828,000 in 1 year. So the question also asks us to journalize. This is the journal there. Investment at cost. You will debit it, and then credit cash that you use to buy the investment. This is to record investment in John Bars International at cost. Then in the year 2024, a lot of things happened. So we're going to recognize all those ones, both the ones that were in John Bars' book and the ones that were not recorded. We're going to add all there. Exchange difference. Exchange difference here is negative. So as it is, it's going to reduce the value of the investment. So that's why we are going to debit exchange difference and credit investment in John Bars International. Note that investment in John Bars International is a debit. in their book. It's a debit in their book. So when you credit it, that means you are reducing it. When you debit it, you are increasing it. Now there is revaluation surplus of 2 million that was already recognized and 2 million that was not recognized. That is 4 million. So if you take 20% of this, you have 800,000, which is also increasing investment in John Bass. So you debit it and then credit uh, revaluation surplus. Then there is also impairment loss of 5 million, which is here, and we have to uh, debit impairment loss and credit investment in John Bass International to reduce the investment. Then a profit of 11.64 million was made. That profit is going to increase the value of the investment. So we debit investment in John Bass International and then uh, credit retained earnings. Sorry. Retained earnings. Then again, we have tax. The share of tax of the profits made by John Bass will also be recognized. So we are going to debit tax and credit investment in John Bass International to reduce the investment. So this is the journalizing of that transaction in my GF PLC books. Note that in answering the question, you must give narrative for all the lines, journal lines that you have made. A complete journal line must have narrative to show what you have done. After journalizing, we are required again to show the extract of the transaction in the book of my GF PLC. So we have the statement of financial position. The extract will be non-current assets. Non-current assets. We'll have the PPE will be reduced by the impairment, 1 million naira. And then we have investment in John Bass International, which will increase from 20 million to 21,828 naira. We are assuming that it has not been recorded, so we are bringing all the amount of the investment here. And then in the current assets, our cash will reduce by 20 million naira. So you come down to the other side of the statement of financial position, equity and liabilities. The retained earnings is 2.910. You will remove the tax and the impairments, which will give you 1,328 million. And then surplus on revaluation. That 400,000 into 2 will give you 800,000. And then exchange difference. That share of them is 300,000 negative. So that will be on equity and liabilities and non-current assets and current assets in the statement of financial position. Then we go to statement of profit or loss and other comprehensive income. We go to other comprehensive income. where it's going to affect the exchange difference, negative of 300,000, and revaluation surplus of 800,000. So these are the extracts that we can get from the transactions that we have done. This is the end of question 3.